Tonight is going to be a quick update of the stock indexes, looking at several different indicators. This is a weekly chart of the S&P 500. There's a Bollinger Bands study on it and 5-period stochastics below it. Currently, the stochastics is overbought and is starting to turn down. However, we are up so far for the week. So until we see a cross of the stochastics and then a break of the prior week's low, that wouldn't be a real good sell signal there. But what I want to point out on this chart is really the Bollinger Band configuration. And notice how currently the bands are in a horizontal channel. So there's a sideways price action happening when the Bollinger Bands form a horizontal channel. You see that type of thing here as well. I'll scroll out here. You also saw a nice horizontal channel at the top of the 2007 bull market high there. So when the market gets to these type of areas where it's in a channel, you got to look for two things: either a move to the top of the channel and then a reversal, or a move to one end of the channel and a breakout. So that's really what to pay attention for here. So if the market continues up from here and touches the upper Bollinger Band, I would say the odds are probably not that likely that you see a breakout. However, if the bands start to expand as the market moves up that way, that would be an indication it may have some upside momentum to it. If the market moves down from here, again, we want to watch and look for any expansion in the bands that would indicate that volatility is increasing as the market hits this support level. And then if it breaks through this support level, there could be a continuation move down there. This is a daily chart of the S&P 500, and it shows the ADX indicator down here. And ADX is an indication of trend. So if the indicator is rising, that market is in a stable trend. So if you look from like this point here, as this indicator rose all the way up to there, that was about as tight, stable a trend as you ever see. Go back a little bit from this area here last July to mid-August there, a very strong directional move. We also saw a pretty directional move from the beginning of May of this year down into the first week of June there. So currently the ADX has declined for a period of time as this market has overlapped, and it's at a very low level. So what this means is over the last several weeks we've had all these overlapping type of moves in the market. That's pretty typical of corrective type of activity, not indicative at this point of a necessarily a stable uptrend. What you look for on this indicator is if it starts to turn up, and particularly if it goes up above the black line here, the 20 line is the textbook line. So if the indicator turns up above that line, whatever direction price is going at that point, that would be an indication that a new trending move, possibly a stable type of price move like that, is developing. So that's what to look for on that indicator over the next few weeks. Watch for that ADX to turn up. Let me click over to the S&P 500 hourly chart. This is SPY ETF hourly chart, and I'm expecting a reversal, not a breakout of July's high here. I'm expecting a reversal at some point close to the highs, possibly a slight new high, and then a reversal there. I think the ideal time frame for that would be somewhere between the next couple of days and the end of the week, so we can look for that. As far as purely technical momentum here, the stochastics has a very strong bearish divergence over the last few days here, which oftentimes sets up a nice swing trade type of a move in the opposite direction. However, the MACD isn't very overbought at this point, and we don't have any divergence, so we may look for the market to continue up for 2, 3, 4 more days and start to hit the upper range that it goes to, and possibly develop a little bit of divergence in the MACD, setting up a short trade there. For any type of long trade, here's the obvious support level. We had this large gap up a couple weeks ago. We came down, filled the gap, rebounded off the gap. So if looking to go long here, you don't want to go long right here. You would look for the market to pull back to a higher low above this support level. Maybe that stochastics would come down to oversold, and then look at going long there. I'm not really looking to do that at this point, but that's what to look for if you're looking to go along the market. As far as the pattern here, a somewhat standard pattern. This is the Dow Jones Industrial. It's a 2-hour chart. I think we may be seeing a combination wave pattern here where we have like a zigzag up, an X wave, and then a flat forming here. A zigzag is a very directional pattern, so it's stronger. A flat is a weaker pattern. The middle part of the move is a strong counter trend move. So this implies potentially that as this market is moving up here, it's weakening because this B wave was so strong. These are the parallel channel lines set from the bottom of B and the top of A. I usually expect the wave C to go at least 61.8% of the B move in most cases. It may come up and slightly exceed that channel line or slightly come below it. They typically don't make a perfect touch of the channel and then reverse. As far as what we need to actually confirm that as a valid pattern is whenever wave C completes and turns down, if this is in fact that pattern, let's just say it completes around that green line there. So let's say it completes right there. The market should then, price action should actually come down and completely retrace this wave C up. It should completely retrace that in less time than it took to form. So by this vertical line here labeled 2, the market should be back below that. Those type of rules are very, very useful for short-term trades and for option trades in particular. Obviously, you can't tell that is going to happen until it does happen, but it does give you after the fact some confirmation that a pattern did or did not complete, so you can then have some degree of certainty going forward that, okay, this corrective move is done, the trend has now shifted to down. We should see significant continuation there. This is stochastics on the Russell 2000 there, and it did make a bullish cross here the last day or so. If the market does continue up higher here for a couple of days, it looks like it could set up a nice bearish divergence on the stochastics where it makes a lower high. In any case, what I would look for is if this daily stochastics makes a bearish cross here, to potentially trade on that signal as kind of a failure in this trend to make a new high, and that would be an indication of a downward move to come there. Haven't showed Apple in a while. This is Apple. I've showed the significance of these red lines before, and what's interesting is those two lines I believe are very significant. And as the market came down and touched that line for support and broke through it, it found support at the next line, then it hovered between there for a month and a half, and it's just come back over that upper support line. As far as this basing pattern, some may view this as a cup and handle type of pattern. If so, it's faulty in that the handle on this is very low. You want to see the handle form in the upper 50% of the price action there, and it's low. So by that measure, this may be a faulty basing pattern in Apple. So watch for a failure of that breakout there. One could also look at this as a double bottom pattern where it came down with one bottom, had a middle and another bottom. If so, this line here would be the center of the double bottom. The market already did slightly penetrate that level and reverse there. What should happen on a successful breakout is the market should plow through that midpoint of that double bottom base pattern to set the stage for a new move. So Apple being the heaviest weighted stock in the stock indexes is one you should watch to get clues for what the market is going to do. I would watch this uptrend line here. The market's found 4 times support there, and so look at the potential breakout or failure to break out of this base and watch for a break down below that trend line. If it does, that could be a pretty good signal that this base has failed and the market will at a bare minimum come down and undercut the low of that base, but probably have a much more significant correction down there. Additionally, if you look at the stochastics, we made a nice high here over the last week. If the market is able to come up close to that old high and the stochastics make a lower high, that's a nice bearish divergence setting up there. So just to recap quickly for looking at multiple time frames here to kind of set the context, the weekly chart is neutral to overbought. If this is a counter trend rally, it should be overbought and should be close to turning down here. On a daily time frame, the market is relatively neutral, but maybe setting up a possible bearish divergence if the market continues up for a couple of days. On an hourly chart, really just looking for a high quality signs of divergence to start to develop on some of these indicators to potentially trade short there. What I would be looking at is if, let's say, we do get a nice short signal here, if the market does come down and completely retrace this last move up in less time than it took to form, that market should continue down quite a bit lower. So you could take partial profits on a position there, but hold part for a continuation of the downward move, or just follow the indicator. But if the market does not come down and completely retrace that move in less time than it took to form, then that would be indication that the market may still have some upside strength in it, and I would keep an eye on the ADX indicator to see if the market comes down and chops around here sideways or slow. If the ADX turns up on that daily time frame and price continues up here, there may be another up leg left in the market there. So that's really all for the stock indexes. Let me click over and check out a couple of other markets while we're doing this here. The gold is in a potentially interesting position here. I put a brief post on the other day, but just to show what's going on here, this is a pretty textbook symmetrical triangle so far. So the way to possibly trade these is if whatever way price breaks out of the lower or upper trend line, you could look at what's called a measured move. So the widest leg of the triangle, which is what these lines project there, the market should at a bare minimum go above the higher low of the pattern in the direction of the breakout. Typically, standard chart analysis will tell you it'll experience a measured move equal to the widest leg of the triangle. I've already showed this on the weekly chart here, and if the market does break this support level that's been set 3 times there could be a sharp continuation move down, projecting this distance on a descending triangle. Bonds are also probably the market that I think is most potentially explosive right now. And let me quickly show this on a 10-year note chart. So this is the yield on the 10-year note. It looks to be like a terminal impulse or ending diagonal type of pattern down here. So this would imply higher interest rates to come, and explosively so. On the bond prices, I'll click over to TLT ETF. You see this bottom trend line of the last few years move angling up here, the top trend line wedging toward it. The MACD indicator on the weekly chart is in a powerful bearish divergence right now on this new high relative to the 2011 highs. So on a weekly time frame, there's a very powerful divergence set up, and I mentioned a couple months back as the market was spiking up here in bonds on the daily chart, to wait for the daily chart to show signs of bearish divergence before potentially going short here. And that's exactly what we're seeing now. The market consolidated over during the month of June and has pushed to slight new highs as of yesterday, being Monday, and it's already come back down off that a little bit. So we have a very, very strong bearish divergence in the MACD relative to price there. Now that doesn't mean it necessarily it's topped here. We don't have a cross down on the indicator yet, but I would be willing, given the long-term context of this, to short the bond market or buy put options on it. Initially what I would look for is once this tops, for this last leg up to be retraced in less time than it took to form, which is basically what this red line projects there. So you could use that projection to choose the strike price on put options, the expiration month on put options, and also the strike price to figure out a kind of maximized return if it makes that move. And then if this is a terminal type of move to the major bond bull market that's been occurring over the last several years, that would imply that this whole move up since 2010, this whole move up here, should be completely retraced in half or less time than this entire move took to form. So we may be looking at a year or less that bond prices are all the way back down here below where they were in 2009, 2010. So those would be some very, very potentially explosive moves, some very good put option candidates. If you trade futures, those would just be massive moves on trading the bond futures. So hone in on that daily chart. When that daily MACD turns down, that's when I would initially look to short there. It's possible you get whipsawed once or twice there. I wouldn't jump in on this until we see that cross, because if the stock market weakens, we may see a final push up in the bonds. But in any case, that's what I'm looking for. So those are the markets that I think are the most interesting right now, and I'll try and update these periodically when potential turning points are at hand. Have a great week.